If you've ever looked at a home listing, done the math in your head, and thought, I just don't make enough for this, I want you to stay right there, because what I'm about to show you has changed the picture for a lot of families that I've worked with who thought exactly the same thing. Hi, I'm Robert. I help families get into homes, and one of the most common things I hear before we even run a single number is some sort of, I do not think I make enough money. Well, today I want to break down exactly what income you actually need, not what you assume you need, what the bank actually looks at. Here's the truth. There's no magic income number that automatically qualifies you or disqualifies you for a home loan. I know that sounds too simple, but it's true. Lenders don't just look at what you earn. They look at the relationship between what you earn and what you owe every month. That ratio is a real number, and once you understand it, you stop guessing and start planning. I've had clients, married couples, 2 kids, 1 income, because she had stepped back from work while the kids were young. They were convinced that they would not qualify. We ran the numbers and they closed on their home in just a short time afterwards. Income was not the barrier they thought it was going to be. The debt was manageable, and that is what made all of the difference. Let me show you exactly how lenders think about income. It's not what most people expect. Lenders use something called debt to income ratio. You'll hear it called DTI. Here's what it means. You take your monthly debt payments, your car, your student loans, your credit cards, and other loans, and they divide that total number by your gross monthly income. Gross meaning before taxes come out. So if you're bringing home $4,000 before taxes and your total debt payment, including what your new mortgage would be, comes out to around $1,600 a month, your debt to income ratio, or your DTI, is 40%. That's the math. That's it. Most loan programs will allow for a debt to income ratio up to 43%. Some even go up to 50, 55%. What that means for you is that you may have more room than you think. I want to give you a real example. You have 2 buyers with the same income, $5,000 a month. Same goal to be in a home around the $250,000 range. Buyer A has a car payment of $450, student loans of $300 a month, a couple of credit cards totaling $200 a month. That is almost $1,000 in monthly debt before we even add a mortgage payment. Buyer B has 1 car payment of $300, no student loans, no credit card balances. That's it. Buyer B only has 1 credit obligation. Same income, completely different outcome. Buyer A is going to have a much harder time qualifying. Buyer B is likely to sail through. The difference is not how much they earn, it's how much they owe. Now, I know what you're thinking. Okay, Robert, so what does that mean for me? What income do I actually need? Here's how I think about it. If you want to buy a home in the $200,000 to $300,000 range, and that covers a lot of markets across this country, and you carry a moderate amount of existing debt, you are generally looking at a gross household income in the range of $55,000 to $75,000 per year. That is a wide range on purpose because your specific debt matters. Now, if you're in a higher cost area, that number goes up. If you have very little debt, it can go down. The point is not memorizing a figure. The point is to stop self-screening before you even talk to anyone. The worst thing that can happen is you decide you don't qualify before a lender even looks at your file. I have seen people walk away from home ownership for years based on a number they've made up in their head. There is one more thing I want you to know. There are loan programs specifically designed for buyers in lower and moderate income brackets. This is not a backdoor. This is not a loophole. This is the system doing exactly what it's designed to do. FHA loans allow lower credit scores and smaller down payments. USDA loans are available in many suburban and rural areas and can require no money down at all. There are state and local programs specifically for first-time home buyers that can help with down payment and closing costs. The key is knowing which one fits your situation. That is not something you can figure out by Googling. That is a 5-minute conversation with a lender. Before I wrap up, let me tell you the 3 mistakes I see most often from buyers when it comes to income. Mistake number 1, take home pay as the benchmark. Lenders use your gross income before taxes. If you've been calculating what you can afford based on your net check, you've been starting from the wrong number. Mistake number 2, forgetting about joint income. If you're buying with a partner, lenders can count both incomes. A lot of couples only think about their own paychecks instead of the household total. That changes the picture significantly. Mistake number 3, waiting to pay off all debts before trying to buy. You do not have to be debt-free. You just have to be within the ratio. Paying down high balance credit cards can shift your DTI enough to qualify without waiting for years to clear everything. Now, we're at that time in the video where we want to dispel some myths, okay? So let me kill 2 myths before we leave. Myth number 1, you need to earn 6 figures to buy a home. That's not true for most of the country. Median household income in the United States is around $56,000. Median income in the United States is around $76,000. And millions of families buy homes every year at that level and below. 6 figures is a goal, not a requirement. Myth number 2, if you're self-employed, you basically cannot qualify. This one drives me crazy because it keeps a lot of entrepreneurs on the sideline for no good reason. Yes, the documentation is different. Yes, lenders look at your tax returns more closely, but self-employed buyers qualify for mortgages every single day. It takes the right lender and the right loan type. That's all. Here is what I want you to take away from this video today. Income alone does not decide whether you can buy a home. Your debt to income ratio does. And this is something you can actually manage and plan for. If you've been holding back because you assumed your income was not enough, I want you to stop assuming and start asking. The only way to know for sure is to talk to someone who can actually run your numbers. If you want to do that with me, I have a free discovery call where we just talk. No pressure, no sales pitch. You tell me where you are, I tell you what I see. The link is in the description. It is simple and it is free. You worked hard for your income. Do not let a number you guessed at keep you from the home your family deserves. If you're ready to take the next step and find out where you are as it pertains to your readiness to achieve your goal of home ownership, I would love to have a conversation with you. Why? I'm a lender. My NMLS license number is 180100 and my contact information is pinned in the top comment and in the description of this video. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let us let grace abound. Watch these next 2 videos here. They'll help you in your education as you prepare to become a homeowner and achieve your goals. And for the rest of you, indeed, y'all stay blessed.